Let's welcome in now our closing bell headliner. He's Marc Lasry. He is chairman and CEO of the Avenue Capital Group, and he is, as you see, back with us at Post 9, and we're so happy to have you. Nice to see you.
My pleasure.
So I want to talk to you about a lot of stuff, but I want to start with credit, okay?
Sure.
Your wheelhouse, private credit, okay? There's a bankruptcy of First Brands. It's an Ohio-based auto parts manufacturer, but a lot of stories being written about it. People are talking about it, wondering whether it's the canary in the coal mine, so to speak, of private credit. They borrowed a lot of money away from banks. You've had talk about the so-called shadow banking system for a very long time. Then there was a subprime auto lender, Tricolor Holdings. They filed in September. They had strong credit ratings, and then all of a sudden, here they go. Are these things to worry about in what people have been talking about as one of the hottest and fastest growing asset classes out there, private credit?
Look, it's an issue, and the reason it's an issue is pretty simple. What ended up happening is you were able to borrow money very easily. So you borrowed more than you needed, and you did it on aggressive assumptions. So if anything ended up happening that was bad, you were going to have a problem. And that's what's happened with these two companies. So if you look at what's happening in the market, what's happening is the economy is slowing down. Mm-hmm. So because of that, you're going to have less growth. You're going to have less earnings. So you're going to have more issues. So this could be the beginning. But the one thing that you've got that I think could save everybody is if the Fed keeps lowering rates, because then the cost of that capital is going to keep going down.
Okay. So Jamie Dimon has been one of the more outspoken voices about private credit and thinking about what might happen down the road because of the explosive growth in the space. He's called it a, quote, recipe for a financial crisis. The size of that market's now $2 trillion. His point was exactly yours. It hasn't really been tested in a moment of economic either weakness or any level of distress. And some are saying, well, maybe this is the first sign of that. Another expert I read put it as private credit, quote, is built on optimism and opacity. You hear that kind of stuff and you think what?
One, I don't disagree. I think it's definitely built on optimism because you've had sort of 10 years of just positive growth. So people assume things are going to keep working out. If anything slows down, that's going to be a problem. And do you have enough to cut expenses? So on all the companies we're seeing today, what we're seeing is there's a greater need for capital. Mm-hmm. And the simple reason for that is because people are having issues, right? So I think if that continues, you are going to have a mini recession. But I think the fact that the Fed is lowering rates might end up staving off that recession.
The issue in and of itself, and you alluded to, you smiled when I read it, it's like the opacity of that market. I mean, you've seen a lot of markets come and go. You've seen a lot of things in these markets over the decades that you've been doing this. I mean, when you have opaque markets like shadow banking is, you open yourself up to potential issues down the road that people don't foresee. That's the problem.
I totally agree. Here's the issue. If you told me everybody was lending money at 4 times EBITDA, I would tell you it's not an issue. If you're telling me it's happening at 6 times or 7 times, then it's going to be a problem. And that's the opacity that you're talking about. So since we don't know at what level people are lending, that's why you could have problems, and that's why Jamie's saying what he's saying.
You're a lender, right?
Yes.
To people who come to you. You have a specialty lending business. We've talked about it almost every time that you've been here with me. I mean, how are you thinking about it? What's the status of it? Is it still robust?
It's very robust, but again, we lend money when people have no choice, right? So we can dictate the terms. And that doesn't mean we can lend out $1 trillion, but what it does mean is you can lend out $1 billion or $2 billion, and that's what we're doing, and we're doing it at a 3 multiple or a 4 multiple, so we think we're more than adequately covered. What's happening on the private credit side is nobody really knows what's happening there, and is this the beginning or of the end? I don't know, because I don't know at what levels they lent money.